Apple just dropped their big WWDC 2025 event. New liquid glass design, check. But AI, not really. Just some Siri updates and a few smart features. And the market, well, let's just say they're not impressed. Apple stock took a hit right after the event. So what's really going on here? Was this a sell the news moment? Is Apple falling behind in the AI race? Or is it a good moment to pick it up? We'll break it down and show you what the valuation says. Let's go. Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we're going to look into Apple. And we're going to do this with our trusty steps of how we do valuation. So first we'll look in what's in the news. We're going to go over some company fundamentals. And finally, we'll leave you with the value that you want to get out of this video, the valuation of Apple. Of course, guys, not financial advice. Do your own due diligence, and preferably so with 930. All right, Kirill, take it away. What's in the news?
I think you said it all in the beginning, so I'll just pull this lovely liquid glass. Yeah, but guys, I'm not gonna show anything. Like when a company says, "Oh yeah, we release Apple Intelligence, and we're also gonna abbreviate it as AI," then I think is something is definitely going wrong in here. Really, if you're always trying to be on the forefront of innovation and R&D and everything, and you're just doing liquid glass, like you're like, oh yeah, let me reinvent Windows Vista from, I don't know, 15 years ago. I think when I was born I started using it almost. But it's kind of disappointing at this point. But yeah, I think what's the most important part is the user part is one thing, of course, if you're happy or not happy with the products, but most importantly is how the stock is performing, because I guess that's why you're here. You're like, yeah, but maybe it's bad, maybe it's good. So that's what we're gonna look into, shall we?
Yeah, before we dive into it, let's just really discuss what Apple's main strategy is here. We should not forget that Apple is not really an early adapter when it comes to tech. They are really good in developing the tech as it is. So, for example, the iPod when it came out, it was really innovative, but it basically was a Walkman on steroids, right? So they didn't invent something that could play music in your pocket, basically. Same goes for iPhone. I mean, the smartphones were already out there. Same goes, for example, for laptops. So, and also, for example, lately with these AR glasses, they are not new, right? They weren't the first one to invent them, and they weren't also the best. I mean, subjectively speaking. So, yeah, you have to keep this in mind that they're now behind the ball when it comes to AI, and investors do get scared, right? Because AI has become a buzzword in all financial statements of all companies. Doesn't matter if a company sells cheese, for example, they use AI in some way or shape or form, as they say. Um, but yeah, of course, people or especially shareholders are uh, disappointed with something that they were expecting something major, especially when you listen to the news with the strides that OpenAI is making, how well Gemini is performing alongside on Google, and how more people are using it. So of course, people were like, okay, now Apple's gonna drop something AI like, and then they did, but it's like Apple Intelligence, and you just do a massive facepalm. So I think people just really got scared, and yeah, that's why it plummeted. And as I said, that might be the reason, or at least a good time for you to pick it up.
Yeah, it's really a matter of just again figuring out the valuation, as we always do, and especially with the fire exit of Warren Buffett. You know, who knows? Is there going to be enough fuel in the stock later on? But yeah, let's just get into it. And I think from the
Yep.
financials perspective, we don't really have to go too much into it. We can just briefly go over. But to be honest, I also gotta admit, it's not even, you cannot even see a drop properly. Still an increasing pattern. There's higher highs and higher lows in the stock price. Of course, you can see like more or less a longer term dip since December of last year, but you cannot call it like terrible. We're talking about $200 per share, and we've been there since let's say 1st of May, so for the couple of months. So it's not that bad. So it's not like tanking or it's gonna be dying anytime soon. And also you can see that the 930 score is also showing B, which is it's quite good. It's like it's not the best in class, but the B is a B. You know, it's definitely a pass, and it's way better than it's better than a pass. So yeah, if we go into the rest of the stuff, I think what's probably the most important to see is that the gross margin is almost at the 50%. Quite often in the big tech, you can see even 60s and 70%, which is crazy. But then again, Apple is a behemoth. It's really hard for it to grow and keep the margins high, but it's still high according to the average market rates. So
Yeah. Yeah, we can also that's something for the viewer to check the due diligence on what they make a lot of money on. It's mainly iPhones, so it's good to check, what the margins are on those, how everything like this would affect such a thing. But also remember that most of the time people are paying for the brand, so you also do have like a really cold like following for Apple products. Those people that have really incorporated in the ecosystem, they have everything, and switching costs are really high. So.
yeah,
That's something to keep in mind.
and especially if you're hooked up on the services, because I think they are the highest in terms of the margin. All the Apple Care, all the insurance kind of stuff, the iCloud thingies and everything. That's probably the stuff that is still making them a lot of money. And the only thing that you still need to keep up with is the infrastructure. So, if you would think like, yeah, okay, I have everything in my iCloud, I have all my ecosystem in there, it would be still tough for people to switch to any other product when you have your whole life in there. So Apple is in such a lucrative position that they pretty much stopped innovating for like how many years already, but people are still buying it because they are hooked up. Yeah, so the moat in there is crazy high. Yep. And that's a good sign, of course.
Okay, so if we look at the company information, it looks really good. So just keep in mind that the company information is going over all financial years, and we're working on improving that so that you can have your own sliders, right? But for now, just keep it in mind, this might be more rose-colored than it actually is. But we see revenue growth, we see average income growth, we see free cash flow growth, double digits is really nice. Their long-term debt is covered by free cash flow, really good. They are buying back shares, and they're also increasing the dividend. So they are increasing the value for you as a shareholder on multiple levels. So that's really good.
Fully agree, yeah. And I think, as Robin said, what's most important now is to see where the devil lies, and the devil usually lies in the details. So what we can see, at least for the past few years, you can see that the net earnings are pretty much flat. So again, it's probably already hitting the ceiling in terms of the increasing its bottom line. So of course, with the increase of the revenue, which is not really there anymore, of course, in the beginning, in the early 2000s, yeah, that was firm and steady and it was going good. Now it's not there anymore, so it's just a big cash cow. What's good to see, though, yeah, is the shares outstanding going down rapidly ever since 2013, let's say. And yeah, and the free cash flow is more or less also steady. Long-term debt, they're also paying it down just fine. Just a well-managed cash cow firm at the moment. That's it.
Exactly. Yeah. If you look at the key ratios, because I'm really curious, you said the devil's in the details, and I'm curious to their R&D spend. I don't think it's that high, but just curious on that. And I'm also curious for their so the research and development ratio is below 20%, so that's really nice. That has to do with the moat, right? They don't need to constantly innovate, and that's also what we said in the beginning.
Yeah, it's something that is a good thing, financial performance-wise, but it's a bad thing because people still have high expectations of you. If you're selling yourself as I'm an innovator of a company, and then you're not delivering anything, yeah, that's also not good. So you gotta manage that as well, as Mr. Tim Cook.
Yeah, they're basically a designer brand at this point for tech.
Yeah. Good point. good one. I like
Let's
it. I like it.
Okay, Kirill. So basically, now that we've looked into these graphs that we wanted to check out, is there something you want to go over? Is there something that you would like to investigate further when it comes to the ratios?
To be honest, no. I think what's something that highlights the fact that it's a cash cow, decreasing rates of the free cash flow growth and the revenue growth for the past, we can say almost more than 10 years already. We can say, that's probably the most dangerous part, and then it also reflects in the net earnings. So I would just say, if you're just really looking for, let's say, keep on increasing dividend, for instance, or if you're just looking for share buybacks with more or less of a stable company, Apple is probably good, but don't expect any miracles from it, at least with the way how it's currently managed at the moment. From the product pipeline perspective, from the perspective of any innovation and stuff like that. So if it has been like that for the 10 past years, the only thing that can change it is the change in strategy, probably management potentially as well. So just keep in mind that if you would be interested to buy it. But then again, the question is at what price?
And that's where we're gonna go now. Nice bridge crew, I like it. Ooh. Let's go into the valuation.
Yeah, you see? Perfect bridging, huh?
So, as usual, in our web app, we can change the years on which it calculates the assumptions, right? So we can do either 3, 5, or maximum amount of years. Maximum, I think, in this time frame is 20 years. So for the 3 years assumption, or 5 year, I think that's the most accurate assumption at this point, because we don't have the heydays of Apple anymore where it's growing crazy. So I would say, can you check 5 maybe? What did 5 says? 2.35%.
It's exactly the same as 3 years. It's exactly the same as gonna be in the next 5 years, I can imagine, unless it's gonna start going even lower than that, I feel like.
Yeah. So the PE ratio is quite decent for big tech. The average is 29. 30-ish, with the highs of 24, no, low of 24 and the highs of 37. So, I mean, yeah. If we go into the free cash flow starting point we'll use last year, the projection period, Kirill, what do you say? Because I don't think Apple is going to go anywhere, but I might assume you don't want to hold this stock forever. Some more interesting companies might tag along. Meta might chew up some market share. Yeah, and sure. Of course, like you have these Chinese phone brands that are coming up. Yeah. So and the tariffs, of course, trade wars. So all considered, what would you say the projection period is for a company like Apple?
Well, it's always funny because we also thought the same about Nokia back in the days, right? Even we did some business cases when we were studying that was mentioning Nokia and I don't know, any other brand that was dominant, that was there all the time and everything, and then boom, it just disappeared all of a sudden. So you never know, but then for that you can also put some margin of safety to just have some insurance, let's say, on it. But I think I agree with you. With such a big moat that they're trying their best to ruin, they're still not able to ruin it over the past 10 years. They're really pushing it, but will it last for another 10 years? Probably will. But will it have the same growth? Yeah, inflation adjusted probably as well. So I think it would be okay to put 10 years in my opinion.
Right. And for the discount rate, we normally use 10%, but you can play around with this number as you see fit. If we look at the average, the estimated growth rate. Okay, so do you want to know what the analysts think of Yahoo Finance?
200,000% all of a sudden, because they know something that we don't know.
No, so it's actually lower than they say that the S&P is going to grow. So for the current year, it's going to grow by 6.5%, and next year it's going to grow by 9%. But I think that's pushing it
Google Glass is gonna save the world, I guess, huh? So that's what that's what they think.
Liquid glass, yeah,
Oh
bro.
yeah, liquid glass. Yeah, sorry, liquid glass indeed. 2%. That would even be too much for them, I think, especially for the 10 years. But let's keep 2% because it's also you're saying for the upcoming year, right?
Upcoming year 6, next year 9.
Yeah, sure,
So
sure, honey
current year
moment.
6.
Yeah, sure. Nah, yeah.
I think they still need to adjust it. I think the analysts are still like, oh, after the WWDC.
Yeah, I don't know. No comment.
Okay. So the projected PE ratio, yeah, we most of the time use the average, but would it be also okay to use the lower side of things, considering that earnings might go a bit lower
Yeah,
or not
it
grow as
should
fast
be.
as?
It should be around 25%, even 20, because there's no growth anymore. So
Mhm.
the only thing which we're paying for is probably the share buyback, and the dividend growth. That's it. I don't see anything else in here. So I also don't believe that it's deserving. I don't know, some crazy multiples. What
Yep.
25 is like, yeah. Nowadays even 30 is considered as an okayish P ratio. So we're talking
Especially for
peanuts
big
now.
tech.
Yeah, exactly. So
But I
that's
mean, compared to, for example, Meta or Google, right? The companies that are still growing, still acquiring a lot of companies. In Apple, not really. If we go to the required rate of return, with a if you buy an index fund, you would get around 10%, 7 to 10% annual returns, right? Historically speaking, because you're stock picking, we always say give yourself an extra percentages because you are getting more risk. We do normally between 11 and 12%. But if you want more returns, of course, if it's a higher risk bet, maybe like it's a small cap stock, a penny stock, for example, you want to have more return, of course. You can get plotted in and it will calculate it for you. Margin of safety is how much risk tolerance you have or how much knowledge you have about the market, industry, the product, the company, right? So for us, I think for Apple, I want to give it maybe a 10 or 20% because it's not a difficult industry or business to understand. But then we also might have to factor in the margin of safety for the fact that, maybe it's not going to grow as fast as people think it is. All right. And what do we do in interview? We press
the purple button which says analyze. Yes, exactly. Mm, yeah, makes sense. Really makes sense. We are talking about the average valuation of 100 US dollar. Um, What's the reason? Pretty much again, no growth. Really no growth. The only thing which is an outlier is the target value valuation formula, but this one is purely based on the fact that it still has more or less good half TP, and we're still talking about 10 years of projection. So and plus the EPS, of course, because still they're keeping more or less healthy bottom line, right? So the earnings per share are quite good as well. So if you would be also applying the margin of safety, we're talking about $80, of course. The current price of $200 is, yeah, we're talking about twice as much as the average valuation at the moment that we're talking about. But then again, guys, the beauty, let's say, of this is you can plug in any kind of assumptions in here. So you can just do it yourself. Maybe you don't agree with us, rightfully so. Maybe you know something more about Apple that we have no clue about. We're just liquid glass and stuff like that, but you know something actually cool that they're cooking in there. So yeah, you can adjust it, and then you're probably gonna see some better numbers. And then again, if Robin says 9% in the next year, maybe it's a good deal. Maybe it could be potentially good. But then this is the beauty of it is that you can just do it yourself, and I think that would be
Exactly.
also a great bridge, right?
No, not yet, because I
No?
still want to say something as well. Is
Yeah.
you can of course look into the average valuation, but you also have to consider which model or which formula is most applicable to this case. Because for me personally, I wouldn't discard the target valuation formula as being accurate in this case. If it's going to keep healthy bottom lines, for example, if it's going to stick to its PE ratio, if they're if they keep the shareholders happy with just buying back shares and increasing dividend, It might actually be that the stock is currently worth $250, and then €100 is quite a good deal. But it's up to you. It's if that makes sense to you, then of course no financial advice. But it might be a reason or a time to jump in, because then, you're buying it for 50% less. No, 20-30% ish of what it's worth, and that could be a good deal for you, right? So, and that's the beauty of our sheet, if you understand. And of course, we are also here to learn, and also to help you with the process. So, as we already did, you can press all the I buttons, and it shows you the formula, the calculations, and then you can make up your mind. Okay, which formula does fit this company best? And I think I wouldn't per se dabble with Apple at this point. I think it's still a bit too high. But for example, with the target valuation formula, I think if that's something that makes sense to you, could be a good guideline.
Yeah, I cannot agree more, actually, with you, sir. Good point.
And with that said, of course, now you want to know where you can get the sheet in Kirill.
Yeah,
Where can we do so?
and now the bridge kicks in. Yeah, we'll be short. You can go to 930.com. The link will be definitely in the description. Simple. You can view the demo platform for free, just to navigate around, to see what we also showed you guys. You can create a free account, also simple. And then we have multiple tiers. You can also get the starter pack. You can get advanced, which is a small monthly subscription of only €3. So get in, get all unlimited insights, get the watch list, get the screener, all the juicy perks and everything at 930.com. And I think that's about it. And get on board with us.
Exactly. And my advice, guys, just try the free version. Just go there, look at the demo account. We don't need your email. We don't need your credit card. No, nothing. Just scroll down, see if you like it. And if you like it, hey, maybe sign up for the free version. We don't even need your credit card then. And if you like it, then you can decide whether you want to buy it. So first try it out. Make up your mind if this is a good process for you. And if it is, then we're here to get you further. And with that said, Kirill, thank you for being here, for your lovely insights, and for your liquid glass. Thank you for watching, and we'll see you guys in the next video.